Welcome to Smart Money with Chris Swartz. Living life on your terms requires more than income. Smart Money connects you with the people, tools, and strategies that turn income into freedom. Most people believe that beating the stock market consistently is nearly impossible, but today's guest has done exactly that. Rajive Jain started his career in fashion and later worked as a software engineer in the Silicon Valley before teaching himself how to invest in public companies and building a seven-figure portfolio. Over the last 5 years, he's compounded his returns at 24% annually. Today, we're breaking down the systems he uses to find opportunities most investors miss. Rajiv, welcome to Smart Money.
Hi, Chris. Pleasure to be here. Thank you.
Yeah, thanks for joining us. It's been a long time coming. We got to meet. Rajiv and I met in Bali, so probably one of the most beautiful places you can meet. And we had some great conversation. I want to share some of those tips and all the techniques that you share with me because, I mean, you just had my head spinning with value investing. I guess before we kind of dive into that, though, let's just talk a little bit about your background because I feel like you have an interesting little diversion here into value investing. So let's talk about that.
Sure. So, a long time back, I had the medical emergency because of which I figured out, hey, I want to do something that really interests me now, and I just don't want to be in the fashion business. So, I worked in the fashion business for a decade, right? And then it was like, hey, the heuristic was if I have to do something at 2 a.m., and I still do it for free. Maybe that counts as a passion. And I landed on two things, which was software and stock investing. So I went through the whole software route, became an engineer and stuff like that. But I didn't know anything about stocks. I read up, tried to find out who are the best people, what philosophies they use. So I followed along that path. Along the way, I was doing my career as a software guy. But during this process, I started investing, learning from my mistakes and stuff, and then went on to actually start seeing a lot of success. I had failures too, but the successes overrode the failures by a large degree. And that got pretty interesting, but I was still doing a job. And so I continued in that process. Post COVID, what happened is I really dived fully into it. And as you mentioned, I had some pretty good results, but I was always a proponent of, I knew I did not have the skill set to do trading. What I wanted to do was be able to invest and sort of keep my money safe and have it grow. So that's why I kind of landed on the value investing approach, read about that, read about a lot of the nuances around that, and so then went on from there.
Yeah, and you read, you had shared with me, I think probably every book out there around Buffett and, Charlie Munger and all of those. I guess it's kind of your, I'll say like mentor from afar, right? You really follow Buffett's strategies.
Correct. It's interesting you say that. If you read a book from a person who's brilliant in what they do, they kind of become a mentor to you, right? It's kind of a
Yeah.
remote way, in a virtual way, but you get their thoughts, you get their learnings, right? I looked at it that way. So there was Charlie Munger, there was Warren Buffett, there was Benjamin Graham, there was Monish Pabrai, and lots of other people. It became kind of like a drug. It was like an addiction for me. Any new book would come out, I would pick it up, read it, and then try to think about it through analyzing the statements and understanding and implementing it.
Yeah, exactly. You can still be a mentor, even if it's, from a book. And I know, through our conversations, you had shared so much of that you pulled out of those books and you've just been able to, really create this system. And I think one of the really neat things is you had shared with me when we first met the reason, and you may not remember this, but, the reason you'd come up with this system you shared with me was to help, I believe it was your son.
Correct. Initially, I was like, as I studied and understood this, I realized that a lot of people don't own their prosperity. That's the term sort of I have for this. You got to own your prosperity. And there are very few fields out there, if you think about it, that what you do yourself, you're 100% in control of this ability to either make money in the markets or not. And then for me, it was like, hey, I got to teach my son this because
Right.
tomorrow, life's getting tougher for everyone. There's a lot of change in the world. But if he could learn this one skill, hopefully he will always be successful in a certain way. At least he would have the reasonable comforts in life. He's able to do that correctly over a period of time. And he's young. So he's got time in his favor.
Yeah, that's what I love about it is there's so many people, including myself, like my background is heavy, real estate investing, mortgage finance. Well, the stock market is just this like unknown, mysterious place where some people get really rich and then some people go broke, right? It's very similar to what we might call the casino, right? If you don't have the right strategy and plans, let's talk about a little bit like what kind of skills, non-mathematical skills, are necessary for success. Because this doesn't have to be this overwhelming, mythical venture here. This can be broken down into really bite-sized systematic chunks that everyone can do, right?
You're absolutely right. So I'm not, let's say, a finance portfolio investment guru expert sort of things that a lot of the old MBA and finance sort of universities churned out, right? So the important thing here is you don't need to be an accountant to understand what's called the language of business. And the language of business, I realized, is just understanding the financial statements. And anybody can do that. There are lots of resources available today. And once you get a hang of that, you begin to understand how you can value a business. And that's the key point here. Because if you understand the trajectory of the business model, and how to value it, then when you go into the stock market, you have these sort of guardrails along which you can go and say, hey, I'm looking at this company or this stock, and it seems to be pretty valuable compared to the price that you see it on the market. And in terms of skill set, as Buffett himself has alluded to, you do not need high IQ to succeed in this business. A lot of it has to do with temperament. With the
Mm.
right temperament and staying calm and rational, it contributes a lot to your ability to have success over a period of time.
That's a good point. Over time. So for those that are listening that don't understand the type of trading that you do, let's talk about specifically what the type of trading is that you do. Because a lot of people think stocks, they think day trading, they think in and out, but you just mentioned time, and I think that's a really important piece to what you do. So let's kind of break that down a little bit.
Sure. I think time is the biggest component of success in this. So time's like I think if you look at it, it's like the biggest free leverage you can have towards wealth. Now, why is that? Because there's something called a compounding curve. If you buy something of value that continues increasing its value over a period of time, and if you extrapolate that over 5 to 10 to 15 to 20 years, that latter half of that curve is phenomenal. It's exponential, right? Because we've all seen this. It kind of goes up. And that's the whole point here. So if you have time to your advantage and you buy good quality businesses at reasonable prices, then short of maybe fraud or some real situation that happens, let's say like Enron or something like that, you should do reasonably well actually.
Hmm.
And the compounding does its work for you. That's the key aspect here. And compounding doesn't involve, it's not fancy formulas, it's understanding the business. So for example, if I looked at a credit card company over 5 years ago, right? And I was like, and in fact, I purchased that company twice. So over the 15-year period. And now I kick myself wondering why I shouldn't have done the initial purchase, a lot of it in the beginning, right? In the beginning of the 15-year period. But having said that, I went in again, and to me, it's a compounding machine, that company, right? And
Hmm.
naturally, there's certain metrics by which you can judge the quality of management, the company, and so on. But then over a period of time, I can understand that the intrinsic value of that company is growing dramatically, because of which I took my position. And that ended up resulting in like almost like a 350% return in just 5 years. Now,
Wow.
and there are a lot of other companies like that. There was an insurance company that I identified that was increasing its intrinsic value in a conservative way. By conservative way, I mean you have the Benjamin Graham mold of valuations where you use things like price to book ratio and stuff. But if you look at a company that's increasing its book value alone by, let's say, 17%, that makes you take a double take and think about, okay, what's happening here? You want to dive in and you want to see what's going on here, right? What's happening in this company, right? And the funny thing about that insurance company was even its earnings were compounding reasonably well. So when you take those two together, it's a double whammy, right? You have the book value, which is increasing, but you also have the earnings picture, which is reasonably good and it's increasing over a period of time. Then the only thing you have to do is figure out at what price you can purchase this stock. And at that time, I kind of always say that luck plays a part in this, because at the time I got to see it and I was like, oh, now if I do the valuation, it seems very cheap compared to what it should be. And so I moved in a position, and that's been a 350% position. And the funny thing is, I bought those in three different time frames. And all
Hmm.
of those, the minimum is 75% return. The intermediate one is like 280% return. And the highest one, it reached about 350% return.
Wow.
The
I
reason
mean,
for that,
these are phenomenal returns that people would think you only get with like, an IPO that hits or crypto or something that's high risk. But you're talking, solid returns on, like, fair to say, like blue chip stocks or
correct. That's exactly. So that's the other part of the game here, is that I want to be safe, right? So I don't want a company that's just going to keel over and die at the end, right? It's not going to do,
right.
it doesn't work well for the compounding curve. Always keep that compounding curve in mind. So
Mm,
that means the company has to be recognizable. It's got to have some sort of a brand and reputation that it fights against, so that the management is already very cognizant and careful about the fact that if things go wrong legally, they can go drastically wrong. So I keep
okay.
an eye on these kind of things and not kind of get into startups, let's say, that are unknown, but there's no reputational damage in the offing, right? I feel that's important because the interesting artifact of that is there'd be a lot of people who can still look at these companies, but that doesn't mean they're buying at the day that I'm buying it, or I'm not buying at the time that they're buying it. And so there's a
Right.
valuation process to that as well.
So how, without getting too far into detail, I mean, how can someone know? Because that's the key, right? Is like the evaluation process, and how do I know if I'm buying it at the right time? Is there some little things that we can look for?
Yeah, it's hard to predict, right? So
Yeah, it's tough.
you can't really do that. There are certain approaches. So interest rates do play a part in this, but not as much as people would think, though, right? Because when you have a good quality business that's compounding, the interest rates don't really matter to that company more or less, unless it's a kind of a business that depends on the interest rate, right?
Right.
But having said that, what that dictates, what I learned from a research paper from Benjamin Graham is the change in interest rates will dictate the change in the value of the earnings going forward. So you have to keep that in mind.
Okay.
The other aspect of that is really is management of good quality, right? And there are metrics you can use to see that management has good financial acumen. If they have good financial acumen, chances are they are not doing things that could create disasters in the business. So there are a lot of these kind of supporting structures that are easily identifiable from freely available financial statements that you can check and see, okay, this looks like a solid optionality here. Yeah, I used to follow Benjamin Graham's formulas, but
Hmm.
then I realized over a period of time that those formulas need to be adjusted in order to ensure that you get good returns. Otherwise, everything seems to extrapolate beyond any reasonable sense. If over optimism is, I think, a bad skill to have, or over optimism is actually not good in the markets. And so when people project all these earnings, I'm very cautious of that sort of stuff as well.
Yeah, the detriment of a lot of these, big companies is the over optimism. So it's interesting you say that because right now, for example, I mean, we're in some uncertain times, right? Like markets always are impacted by all of these external things that happen around us. And we've got a lot of, uncertainty in the world right now. Some wars are breaking out. These things, happen. And I like the one thing that you shared with me before is by definition, markets are uncertain, right?
Yeah, correct.
So you talk to us, I guess, a little bit about how you handle that uncertainty.
So let's step back. You do not want to be in the game of predictions because, by the virtue of uncertainty, 10 people have 10 different predictions. Then who's to say who's right? So I don't play that game at all. I actually don't do any projections going forward where I'm supposed to predict something because I found out that half the time my predictions could be wrong. And
Mm,
frankly, I don't consider myself an expert, and I don't think anybody should consider themselves an expert in predictions. However, once you've decided on a good quality business and you understand the value of the business, then how you address uncertainty is through what's called the margin of safety. It's a concept that Benjamin Graham and Warren Buffett have talked about a lot. The margin of safety is a very critical factor. If I think a business is worth $100, I shouldn't have to pay $100 for it. I should only pay 50.
mm,
And so if the markets tank or if something happens temporarily in the business cycle or to the business, and let's say the price goes down, now I have two things supporting it. Number one, I bought it at a pretty cheap price. So I'm probably not under the water as much as somebody who bought it at full value. And the
okay.
second thing is the qualitative analysis that I do in terms of management and the skill set gives me the confidence that they'll come out of it.
Okay. So at some point, based on the history and the competence within the leadership of the company, that they're equipped to come out of it.
Correct. The caveat there being obviously now I got burnt by one position that I took because I did not do my homework. So you got to do your homework. You got to do some due diligence, right? And I ended up being in a position where all the metrics looked right and all the valuation of the company looked fantastic. The managers in the business were very good. They were excellent based on the metrics that I saw.
Okay.
Industry was highly competitive and it was a cyclical industry and I didn't catch on to that. And that, even though I think my initial return was about a 50, 70% return, I decided not to sell it. And then competition hit, the forces of competitive nature of the economies hit, and that company just tanked. And that was a
Yeah.
big lesson, right? So industry does play a role. There are certain industries I will never touch. It doesn't matter to me what the analysts say. It doesn't matter to me how optimistic it is, even if it's a monopolistic company. But if it's in a nature of an industry that I feel does not accrue value properly to shareholders, I will not touch it.
Okay. Can we get an example of an industry?
Sure. Well,
Let's spot here.
I would never touch the auto industry. I would never touch airlines. Those are extremely high capex industries, but they have this nature of obsolescence about them as well. Then they have regulatory factors and a lot of other things that put a cap on their ability to grow.
Mm,
Those are things that I think take away from that compounding curve. We always come back to the first principle. The first principle is compounding wealth by taking advantage of the compounding curve. Anything that interrupts that is a problem.
okay. So that's the key focus there is that compounding. I don't think a lot of people understand the power of that compounding curve, and that's why a lot of people are trying to day trade and they're looking at what they put in and what they pulled out today. I mean, how powerful is that compounding curve?
You could have a difference. Now, obviously, I don't have a calculator in front of me, so I'm just going to guesstimate here.
Yeah,
There,
sure.
there's a rule called the rule of 72. And what the rule of 72 says is, let's say if you are making, let's say, I'll take a reasonable hypothetical figure here. Let's say 18% you're making compounding every year, right? If you take 72 and divide it by 18, that's 4 years that you've doubled your money. Okay. So now at 18%, if you've doubled your money in 4 years, in 20 years, you will double it 5 times. That's
Mm,
64 times the money you had in 20 years compared to now.
wow.
That's the power of compounding.
Okay. You're in it for the long haul. And you call it this type of investing is what? Value trade investing?
So I would say value investing is a misnomer because if you think about it, if you don't identify something of value more than what it is at right now, why would you invest in it? And so that question
Yeah.
should make you think that every form of investing done correctly is actually based on value. And so it's called value investing, but the whole process of investing is you are identifying value that you want to participate in the profits from.
Okay. Got it.
So yeah, sorry, what was the question again?
No, no, that you answered it. I mean, to define this type of investing,
Right.
I guess you said all investing is value trade investing, right? That's the goal, So this would be more of just buy and hold strategies, right? What type of timeline are you looking at in this type of trading? As much time as you have to compound, or
So that's the difficult part, right? Because I'm not in the field of predicting of earnings and stuff like that. So what I would like to reasonably do is, let's say 5 or 10 years out, do I see the business model of the company still progressing and increasing its value over that time frame? Beyond that is really hard for me to say, especially now, because we see stuff with AI, we see stuff with new
right?
technologies coming onto the picture, right? And the ability to take value from those 5 or 10 years out from current industries is hard to predict. A general time frame for me is at least I'd love it if I get a company that I can keep for 20 years. Because
Wow.
then the compounding curve really, as I mentioned, by the way, that's 32 times. I think I got it wrong, right? But anyway, the point is that over that 20-year period, if you are able to find a company that can really grow its value over that time, that's huge. But that's becoming a rarity. So then
Hmm.
sometimes you got to compromise either on the valuation, either on the price that you pay for the valuation, knowing that it could be around for 10, 15 years, but I cannot really see beyond that. Now, for some companies, maybe you can't see beyond 5 years. And the question you got to ask yourself is, do you really want to invest in that company if you want to take advantage of the 10, 15, 20-year breakouts in terms of value?
I think especially with like AI and all of the technology, that's got to be hard to even forecast, right? I mean, with the exception of maybe like OpenAI and these companies that just have billions of dollars. I guess that industry seems like would be a little bit of a wild card.
Correct. So let's go back in the earlier part of the century. If you looked at the automobile industry, it had thousands of players in that industry, and automobiles were new. It was a new technology. And so it was rapid dissemination of this technology at the time, the technology of transportation, right? However, nobody could have predicted at that time who would be the winners 10, 20 years down the road. Now we only know about 5 or 10 car companies. The rest, all of them vanished.
Right.
And that's one of the things with new technologies. Because the industry is huge and growing, does not mean you can predict who the winner in that industry is and what their market economics will end up becoming.
Mm,
And I
yeah.
believe in today's world, maybe contrary to popular opinion, I think that same principle applies. There are a lot of competitors in the AI. Think about it. If you have huge ability to bring out an LLM model in every area of the world today, then it's a highly competitive industry by nature.
Right.
By
Yeah.
definition, that's not going to create a monopolist company.
You have to think about there's so many people and so many LLMs coming out to the market.
Right, right. Exactly. So if we take 5 years out, I cannot predict. Now, of course, probably Google's going to be around, Microsoft's going to be around, but I think they're not going to be around. This is my personal feeling. They're not going to be around just because of AI. they already have very strong business models from before and they're entrenched in our daily lives and commercial lives, right? And so I could give them a pass, but I cannot make that guess. And maybe OpenAI or maybe Claude, Anthropic becomes the largest AI company. I do not know. The problem is because I don't know and I cannot predict that, I cannot understand my compounding curve for the future.
You would say you wouldn't put them in your portfolio at this time.
I wouldn't put pure AI players into my portfolio.
Yeah. Not to put one on the spot there, Raji. Let's talk about, a lot of people listening to this, they may be entrepreneurs, they have some capital. How do you apply this to like an entrepreneur?
A great question. So, what I understand is, entrepreneurs have done very well, right? They've built good businesses, exited probably brilliant businesses and stuff like that, right? But does not make them good capital allocators. To be really good capital allocators, you have to understand how money moves through a company and how it generates value, right? And when it comes to the public markets, you got to apply that thought process into understanding how these large public companies operate, right? So if I look at and I've spoken to a lot of entrepreneurs, and if you ask them to go through all the financial statements and their accounting, surprised, a lot of them actually have not done that. Their accountant takes care of it, or they have a CFO who takes care of all that, but they don't really know how the money translates to value or how that value can be further enhanced. However, they do have the basic skill set of what a business is, what the problems of a business are. How do you understand a moat? How do you understand where a dollar churns into out value to the bottom line? And you can take that, you can build on top of that with the framework of what good capital allocation means, and then go out and identify that in public companies. They
Hmm.
already understand business. All they need to do is understand the framework of how you understand value, how you understand pricing, and how you understand reading the language of business, which is financial statements, which a lot of them would be familiar with. You just need to go 2 levels deeper, and that's it. And they can readily do what essentially Warren Buffett, Charlie Munger have been doing.
Interesting. Yeah. So you don't need to get knee deep in the financials to understand, the business models and be able to identify the companies.
Sorry, let me rephrase that.
Yeah.
You have to understand financials, but you don't have to be an accountant. So I'm
Okay.
not an accountant. And if you look at my portfolio results, I have so many 300 percenters, 200 percenters, 150 percenters in those 5 years. So many of them, I've got like 2, 3 slides of them, right? The point is, I was not an accountant, but I was looking at from an investor's perspective and tracing that story of how that company has progressed. I'm drawing essentially what I think Buffett alluded to this, like a canvas of the company. You read the materials of the company to draw the picture of what the company is about, and that will tell you whether it's
Okay.
a valuable business model and what its value is, and then just compare it to the price. And I think a lot of entrepreneurs already have that sort of sense of what business is. So it's just a short step from there to applying it in public markets.
Okay. And as you're looking at this and evaluating and applying this, what are some wrong beliefs, like some things that you can just miss the mark or where people focus that's just wrong?
Good question. So, this concept called beta, for example, it'll come as a surprise to everybody if I say actually beta is not your enemy, it's actually your friend. Now, why is that? If you go back and see let's do a quick 1 minute case studies when Warren Buffett bought Washington Post. Now, for those who may not know beta essentially it's a measure for tracking how volatile a stock is in
Okay.
price on average compared to the price of whatever it's being compared to. Something goes up by $1 and your stock goes up by $2, then it's got double the variation. But that's considered very risky. But now I step back and you think about it. If you have a company that's very valuable, its intrinsic value is high, and it's doing really good business. Business is doing very well, capital is allocated very well, so on and so forth, right? And if that company's price suddenly drops from 100 to 50, or whatever the 100% valuation price is, and it drops by 50%, according to beta, that's a big risk. But
Okay.
according to us, it's not a big risk, it's a huge opportunity because now you got something good, cheap.
Hmm. Interesting.
I think that's one aspect of it. The other aspect of it is really like this over optimization of. So let's say you have valuation models and methods, and I've never seen an analyst that gives a pessimistic picture of a company. And, it's always like, are these guys going to do
Always
this?
good.
It's always good, right? And I'm very wary of that sort of stuff because business doesn't really work that way. Business works in lumpy ways. There will be good years, there'll be bad years, excellent years. The beauty of Benjamin Graham's teachings was you got to normalize those. And only then you begin to understand how the company is performing. And I think a lot of people get so nitty gritty with the decimal points and the percentage changes from one quarter to the other. They are blind to the normalization process that actually dictates the reality of business.
Mm,
If you take that benchmark of reality of business and compare your valuations and all the pricing and the frameworks that, for example, I follow, it gives you a much more conservative picture. Think about that. If you have a conservative picture, you have that margin of safety to begin with already.
right.
But you need to add to that, of course. The whole point there is that you start from that process, but then you further work backwards to try and get as much margin of safety as possible. That is so
Okay.
critical to this process.
How do you ensure that? Is that just evaluating the balance sheet and these various metrics?
So, in the beginning, conservative approaches, which Benjamin Graham espoused, was always the balance sheets. You always start there to understand how the company has progressed over a period of time. And the things you get to know from the balance sheet are things like debt, one of the biggest things, right? And
Okay.
how
Yep.
many assets are deployed in the business, right? But over a period of time, you want to see how that trajectory has gone in the company as far as its assets and that debt and all is being handled, right?
Hmm.
And so that's the first approach. A company has its own valuation in terms of, without diving too much into detail, there's equity value, book value, so on and so forth. Further to that, then you add on what is the earnings picture and the cash flow. And then the third step is really understanding how these tie together in terms of financial acumen of the business managers. Because just because you have a lot of assets doesn't mean you're a good capital allocator in relation to those assets. You could be
Right.
like, look at the car companies. That's the reason why I avoid car companies, because their capital allocations, their capex allocations are through the roof. When you actually look at the cash flow trajectories, they do not, to me, they do not justify the kind of pricing or the kind of returns expectations that I want when I'm looking at my picks.
Interesting.
You look at the financial statements, you get a picture of how this works. And it's very easy once you get into the hang of it and you're like, okay, this is not that hard, because why make it more difficult for yourself? If I don't want to look at one car company, I'm not going to look at 20 car companies. And that saves me a lot of time.
Yeah.
There are 10,000 companies out there, right? Just in North America.
Right. Just yeah, just move on.
Move
And
on.
I like that. And so and you've come up with the system, to really to break this down because some people may be listening and may say this sounds why I don't want to get involved. This sounds technical, too technical. It's not my area expertise. I mean, what are like three simple filters that you can run a stock through for decisions?
Okay. Three simple filters would be, do you understand the business firstly, what it does? Because if you don't understand it, you're already kind of gambling, right?
Okay.
The second is when you look at the balance sheet statements, I'll give one example. If there's very high in debt, I will avoid, because debt
Okay.
can be called. And once you understand how the earnings are calculated, debt has a direct impact on the bottom line, right?
Sure.
That's the filter. The other would be the ability for management to actually generate more value for every dollar they retain in the company. So, you have dividends that are paid out, but there's a reason they kept a certain amount of profits in the company, right? And how do you measure that was worth doing rather than giving out as a dividend? I mean, these are some of the filters that I would look at in terms of deciding, whether a company is worth looking at.
Nice. This is so interesting. I mean, you and I could talk for hours. We had such a great conversation the first time we met, and I think we closed the restaurant beyond
Oh my God, I
the
think that's amazing.
yeah, on the side of the cliffs in Bali. Some great music, great
That's beautiful.
conversation.
Beautiful.
It was awesome. I really appreciate you taking the time to jump on here, Rajiv, and really just sharing with people that you can get involved in the stock market. You can get really high quality returns if you stay in the game and you evaluate the companies over time.
I think I could mention one other thing there, because you asked me about the belief systems, right? I think one of the most deterrent belief systems is this process of diversification.
Hmm.
And I have
Okay.
this saying that diversification is based on fatalities. It's not based on quality. Because if you find quality companies, you want to keep them. But the reason you have different companies is because an entire industry could die, or there could be a geographical collapse of a market. Those are the reasons based on fatality that you do diversification, and no other reason. But
Right.
today you have some people owning 50 stocks, 100 stocks. To me, it makes no sense.
Hmm. Interesting. So when you're thinking diversification, and just speak, you've built a nice seven-figure portfolio through this process and the systems that you use. When you hear diversification, you're not thinking, in my portfolio, I've got 100 stocks.
No, no, not at all. Not at all. In fact, I'm kicking myself wondering, if I have to buy the eighth best opportunity, why did I do it? Because the top five or the top seven were good enough.
I love that. Yeah, simplification is the key here. I mean, this is all super helpful, and I know that you are, putting together more information on this. You've got a course to help people break this down, to get involved, and to really be able to build long-term wealth. Rajiv, somewhere that people can find you, they want to connect, they want to learn more.
Sure. They can go to my website. I have a website called capitalcompounders.cc. I like the
Okay.
.cc part because it's kind of ended up being an acronym for those words. So
Yeah, yeah.
the capitalcompounders.cc. I think I'm on Instagram as well. Rajiv Investor Official. Rajiv _investor _official. Feel free to DM me or reach out or just write to me through my website. Happy to reply back.
Okay, awesome. All right, Rajiv. Well, thank you so much for taking the time to share all this information with us. It's great to see you again, my friend.
Been a pleasure.
And
It was really nice seeing you for so long. Not
all
so
right.
long. Seems long because Bali was great.
I know, too far away already. All right, everyone. Well, for everyone listening, if you got some value out of this, make sure you like and subscribe to the channel, share it with a friend. And I'm Chris Swartz, your host here at Smart Money. Tune in next time for more smart money tips on how to build wealth and live free.
Follow Smart Money with Chris Swartz for more conversations on building wealth with purpose. And if you found value in this episode, share it with someone you know who can benefit, because real wealth is life on your terms.